Banks are the foundation of any economy, including the Fed, which is actually a bank. However, unlike any other bank, it creates money. But if I told you that, theoretically, any bank has the right to create money, you could start a bank and begin creating money. Nevertheless, there's an easier way. So in this video, we're going to delve into 5 truths about money that banks don't want you to know, because if everyone knew this, it could be the end of the banking system. As Henry Ford said, "It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." Number 1. Every bank has the right to create money out of thin air. If I were to tell you that banks create money, you probably wouldn't believe it, because the only bank that can create money is the Federal Reserve, the source of the dollar, the only institution with the right to operate the printing press. However, the banking system operates in such a way that all banks in the country, or even the world, can create money to a certain extent, based on the amount of money people have deposited in them. Imagine you deposit $1,000 in Bank X. What do you think that bank will do with the money? It wouldn't make sense to just give it back to you, nor could they even pay the paltry 0.5% interest. So, the bank lends your money to someone else who wants to buy a car, for example, or a house, and charges interest, which is often much higher than the 0.5% you receive. The average credit card interest rate is 20%, which is literally dozens of times more than what the bank pays you. The point is, the bank won't tell you who they're lending your money to. Whenever you check your account, the bank will show that your money is still there, and you can withdraw it whenever you want. So, if your money is still in the bank, where did the bank get the money to lend to someone else? This is known as the fractional reserve system. Banks can only keep 10% of deposits and lend out the rest. For every $1,000 you deposit in the bank creates another $900 out of thin air and lends it to someone else, bringing the total value to $1,900. The bank has created $900 out of thin air, which isn't as hard as you might think since it's just digits in a computer. Number 2. You can make money by borrowing from banks and investing elsewhere. In July 2012, Mark Zuckerberg financed his $5.95 million home in Palo Alto, which is 3 miles from Facebook's headquarters, with a 30-year mortgage. At the time, he was 28 years old and the 40th richest person in the world, with an estimated net worth of $15.6 billion. The question is, why would he take on debt when he has billions of dollars and could easily pay in cash? He could buy a dozen $6 million homes without batting an eye. The answer is simple: free money. This sounds unrealistic, I understand. Who would give you free money when you are already a billionaire? I mean, why would someone give money for free to another person unless it's charity? It all comes down to interest rates. Remember when we talked about banks? They offer such a low return that it's not worth keeping your money there because it doesn't outpace inflation. In this scenario, it's the opposite. The inflation rate in the United States is between 4.5% and 6%. So any money you borrow at a rate lower than the inflation rate is considered free money. Zuckerberg's mortgage interest rate was just slightly above 1.05%. If we do the calculations, the bank is the loser because the mortgage interest rate is below inflation. You don't need to be a genius to do the math. For example, suppose you borrow $1 million at a rate of 1.05%. The average return rate on a savings account was 2.4% before the pandemic and is now below 1%. But let's stick to 2.4%. This means that even if you deposit that $1 million in another bank, you'll earn $24,000, while you only need to make a monthly payment of $10,500 at a 1% rate to the bank you borrowed the money from. Imagine if you do this with $100 million or even $1 billion. When you can borrow money for free, it doesn't make sense to tie up your own money when you can use it for more profitable things. Of course, when we're talking about small amounts of money, this may not make much sense because the difference isn't that significant. However, when it comes to large sums, playing with interest rates of 1%, 2%, or 0.05% can potentially mean tens, if not hundreds of thousands of dollars. Number 3. The wealthier you are, the lower the rate you'll get. Remember that banks are not charitable organizations. They are businesses like any other, whose job is to maximize profits. They have shareholders to whom they are accountable. If their business model is not profitable, they won't survive. That's why they feel much more comfortable lending money to the wealthy than to the poor. When you're a billionaire, for example, the bank can rest easy because no one worries that you'll default on the loan. And if something happens and you can't make your monthly payments, you can easily sell a part of your businesses to cover the mortgage. This makes lending money almost risk-free. In fact, this is how the banking system has evolved over the centuries, where banks primarily served the nobility and people who had money or assets that generated a steady income, such as land. Compare this to an average employee who can get sick, lose their job, or simply struggle to make ends meet. Lending money to them is extremely risky. I know it's easy to criticize banks for this, but think about it. Would you feel comfortable lending money to a friend who barely makes money or a friend who has a business? It would probably be the latter, as harsh as that may sound. So, if you want to get a lower mortgage rate or a lower credit card rate, simply improve your conditions when taking out loans. First, you need to be in a strong financial situation. Banks also offer low mortgage rates to build strong relationships with wealthy individuals so that when they need a larger loan, they turn to them. It's a win-win situation. Technologies like blockchain or cryptocurrencies promise to change this and democratize the banking system, and they probably will to some extent. In fact, the banking system has democratized to the point where everyone has access to financial services. Compare that to 100 years ago. Number 4, keeping your money in a bank is a ripoff. Let me ask you a question. How much interest would you earn if you deposited your savings in a bank? At first glance, it seems that at least a small percentage would make sense, right? However, if you look at the numbers, it's far from it. Major banks like Citibank offer literally less than 0.5%. There are banks that offer a slightly higher rate, but still don't exceed 1%, especially because interest rates are now at their lowest point. Think about it. Your money is growing at a rate of 0.5%, while inflation is at 3.5%. The real value of your wealth is literally decreasing every year. It's much better to invest that money in other options today than to keep it in a bank, because the purchasing power of your money in a few years will be much lower than it is now. And when inflation surges, as it's happening now, for example, asset prices like houses or stocks increase exponentially, as we've seen in the past year. A bank is a place to store your money, not to make your money grow. Number 5, credit cards are the bank's most powerful weapons. 70% of Americans with credit card debt admit they won't be able to pay it off this year. Take a moment to think about what that means. Your credit card debt is not like your mortgage. It's not at a 3.5% annual interest rate. It's probably closer to 20%. If you can't pay off your credit card debt on time, what makes you think you'll be able to pay it off a few months later when the debt has grown much larger? In other words, 70% of Americans are on the brink of falling into the debt trap. Over half of the respondents, 56%, say they have had credit card debt for at least a year, and most will carry that debt for years to come. About 20% believe it will take more than 3 years to pay off their debt, while approximately 8% say they don't know when they'll be able to pay it off. This is how banks often make fortunes because most people spend without thinking about how they will pay. They are accustomed to a certain standard of living and are willing to maintain it, even if they can't truly afford it. That's why banks keep calling you to sell you a new credit card. Don't get me wrong, using credit cards responsibly is great for building your credit score. But if you're not financially responsible, you shouldn't fall into the debt trap. If you're wondering where you should keep your money or what you should invest in, we have this video that just appeared on your screen to answer your question. If you enjoyed this video, please leave a like to help us bring this content to more people. And if you're not already subscribed, subscribe now so you don't miss our channel's new videos. Thank you for watching up to this point, and I'll see you in the next video.